Welcome back to Investing Talk Podcast.
Today we're looking at United States Antimony. The big question is it a good time to buy now?
We want to hear from you. Subscribe, like, and comment to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. There's a lot pointing towards a really fundamental shift for United States Antimony. The whole story is changing. You know, they're moving away from being just like an exploration hopeful.
Right, speculative.
Exactly, to becoming a genuinely critical supplier. Basically, part of the defense infrastructure.
That's a massive change in perception, isn't it? Going from maybe they'll find something valuable to the government needs what they produce. But what really cemented that? What was the moment that validated this whole transition?
It was pretty clear-cut. Happened back in September 2025. They landed this huge contract. It's a 5-year sole source IDIQ deal with the Defense Logistics Agency, the DLA. Ceiling's $245 million.
Okay, $245 million. That definitely grabs your attention. But let's unpack that IDIQ thing a bit. What does sole source IDIQ actually mean for them day to day beyond the big number? How stable is that?
Good question. So IDIQ, indefinite delivery, indefinite quantity, gives them a framework, right? The DLA can order up to that amount over 5 years, gives some visibility. But the sole source part, that's the real game changer. That's the strategic advantage.
Sole source meaning no competition.
Pretty much. The DLA isn't shopping around for this specific need. They went straight to United States Antimony. That tells you the government sees their capability as unique, or maybe just that the need is incredibly urgent. It really cuts down the risk on future orders.
So it's not just buying generic antimony, it's securing a North American supply chain, basically insulating from global disruptions, especially China.
That's exactly it. Antimony is critical, used in hardening munitions, some battery tech, and really important flame retardants for military gear. And they already got their first order under the contract, about $10 million worth for 315,000 pounds of antimony ingots. So they're proving they can deliver right away.
Okay. But playing devil's advocate for a second, how solid is that moat? It feels very tied to the current geopolitical climate, this whole focus on supply chain security away from China. What if things cool down or China ramps up exports again? Does the advantage just evaporate?
It's a valid concern, always a risk with commodities. But the analysis suggests this is more structural. United States Antimony is the only company running 2 antimony smelters in North America. That's a bottleneck. Even if global trade smooths out, the U.S. policy push for domestic critical minerals is pretty baked in now. The DLA contract itself shows they won't rely on, potentially unstable foreign sources for defense needs. It's a long-term strategic shift.
Okay, that makes sense. Structural advantage, not just temporary. So, strategy aside, can they actually pull this off operationally? What do the financials look like? Can they afford this big transition?
Well, the numbers show a company really turning a corner. Full year 2024 revenue was $14.94 million. That's almost a 72% jump from 2023. So demand is definitely picking up speed.
Big jump in revenue, sure, but are they profitable? Often scaling up costs a fortune, crushes margins.
They're not profitable yet, but getting much closer. The net loss in 2024 shrank dramatically down to negative $1.74 million. That's nearly a 73% improvement from the year before. It shows what analysts call rising operating leverage.
Okay, operating leverage. Break that down for us. What does that mean practically when you're scaling up production of something specialized like antimony?
Right. So think about their fixed costs running the smelters, admin, basic staff. Those costs stay roughly the same. Operating leverage means that once you cover those fixed costs, each extra pound of antimony they produce costs much less to make. Because they're ramping up production for this big DLA contract, they're spreading those fixed costs over way more volume, that huge drop in the net loss. That's proof it's working. They're using their assets more efficiently, making profitability look much more achievable soon.
And crucially, do they have the cash to fuel this ramp up? Restarting smelters, maybe buying other companies? That takes capital.
They seem to. They did a direct offering in October 2025, raised about $26.25 million. That boosted their cash and securities to around $64 million. Balance sheet looks pretty healthy, not much long-term debt. So yeah, they seem funded for the key steps ahead, like restarting the Madero smelter and that potential Larvado deal.
Right, and speaking of those steps, management's guidance is, well, it's bold. Betting the farm on executing perfectly, it seems. What are the targets we should be watching?
Yeah, they're definitely not shy. For this fiscal year, 2025, they're guiding for $40 to $50 million in revenue. I mean, hit the top end. And you're talking more than triple 2024's revenue, mainly driven by that first chunk of the DLA contract. But the really big one, The number driving the whole investment story is the 2026 target, $100 million in revenue.
Wow, $100 million. And the CEO's been pretty vocal, right? Fox Business, Bloomberg,
Yeah.
putting that target out there publicly. That's a lot of pressure. What happens if they miss that $100 million mark? The market's got to be pricing in success at this point.
Oh, absolutely. That's the core tension. The current stock price assumes they hit, or get very close to, that trajectory. A significant miss would raise serious questions about their ability to execute, and you could see the valuation pull back sharply. All the gains from the DLA news could vanish. But, the company's argument is that the upcoming catalysts, the M&A, the operational restarts, are exactly what unlocks that $100 million potential.
Okay, so let's talk catalysts. What are the absolute key things to watch for in, say, the next 3 months? This feels like crunch time.
Definitely. First up is earnings. Q3 2025 results should be out around mid-November, maybe November 13th. Investors won't just want revenue growth. They'll need to see those margins improving and the net loss continuing to shrink. Proof the leverage is still working.
And besides earnings, that M&A deal sounds significant, bringing in international assets.
Yes, the potential buyout of Larvado Resources in Australia. USAC already owns about 10%, so they're involved. The idea is to swap 6 USAC shares for every 100 Larvado shares. It's all about securing their own ore supply long-term, becoming more vertically integrated, less dependent on buying ore from others.
Buying an Australian miner while also restarting a major smelter domestically. That sounds like juggling chainsaws. Logistically complex, right?
Extremely complex. That's the heart of the execution risk. The main operational piece is restarting the Madero smelter. That's not just flipping a switch. It's a huge industrial process they need to get right for the DLA volumes. Both Madero restarting and the first ore shipments from Australia, assuming the deal closes, are pegged for early 2026, maybe February. Add in completing the Alaska Mining Claims acquisition in January 2026. Yeah, the next few months are absolutely critical.
Okay, now let's sprinkle in some of that speculative stuff, the rumors that could potentially push things even higher than that $100 million target. What's the buzz?
Well, the most interesting one links back to the DLA contract itself. There's chatter that if geopolitical tensions flare up even more, the DLA might actually accelerate their orders, pull forward demand from later years in the contract.
So faster cash flow, faster revenue recognition.
Exactly. That would be a major positive surprise.
And the Alaska angle, more reserves than expected.
That's the speculation. That the newly permitted claims up there might hold significantly more antimony than currently factored into the 2026 guidance. If true, that could eventually lower their overall production costs once they're fully scaled up, making them more competitive long-term.
And the macro picture, any rumors about China?
Yeah, persistent whispers about China potentially tightening its own antimony export restrictions. If that happens, it basically shrinks global supply, boosting demand and pricing power for everyone else, especially a North American producer like USAC. That'd be pure windfall, potentially lifting margins even on existing deals.
Okay, so that's the company story. How's the market reacting? The stock price has been, well, a roller coaster.
Roller coaster is the word. Huge swings. The 52-week range is something like $0.49 to almost $20.
Yeah.
$19.71. We did see a noticeable drop recently, over 12% on November 3rd. Seems like mostly short-term commodity jitters, not really a change in the company's outlook.
But even with that drop, how does the stock look technically? Is momentum broken?
It's holding up surprisingly well, actually, still trading around or above its 50-day average. And the RSI, the Relative Strength Index, is kind of neutral mid-range 45 to 56. It suggests the stock isn't really overbought or oversold right now. Maybe that recent dip just brought in buyers who like the DLA story long-term.
And what about Wall Street analysts? What's the consensus view?
Overall, very positive. The average rating is a strong buy.
Yeah.
But the price targets are all over the place. The range goes from maybe $4.40 up to $8.50, which is the median target.
That wide range really captures the whole debate, doesn't it? Is this a volatile commodity stock or a strategic breath play?
Exactly. The gap between those targets reflects how much execution risk the market is pricing in. Analysts seem to think it works for different people, short-term traders playing the news flow, like earnings or the smelter restart, and also long-term investors betting that the whole strategic, secure supply chain narrative wins out over the next few years.
Okay, we've laid out a pretty strong bull case, anchored by that massive DLA contract. But let's ground ourselves. What keeps this from being a perfect 10-10 investment? What are the big risks we need to acknowledge?
Number one, without a doubt, is execution risk. They're trying to cram years of development into about 12 months. Integrating Larvado, restarting Madero, scaling production, doing all that smoothly and on time is a massive challenge. Any significant delay or hiccup could really derail that $100 million target.
And tied right into that is profitability risk, right? They're growing fast, but still losing money. Scaling costs money.
Precisely. Revenue growth is great, but they have to control costs during this ramp-up. If restarting Madero or processing Australian ore proves way more expensive than planned, break-even gets pushed out. And if break-even gets pushed out too far, they might have to raise more money, diluting existing shareholders, which nobody wants to see.
Okay, execution, profitability, anything else major?
Just the underlying market risk. It's still antimony, a niche commodity. Prices can swing. While the DLA contract cushions part of their revenue, their overall profitability will still be affected by global antimony prices to some extent.
So wrapping it all up, where do we land on United States antimony?
Look, the setup is compelling. The strategic shift, backed by that huge sole source DLA contract, is undeniable. We're giving it an overall bullish rating, let's say 8.5 out of 10. The whole thing really boils down to monitoring the execution. Can they handle the complexity? Will the Larvado integration and the Madero restart deliver that $100 million revenue in 2026 smoothly? Or will the execution challenges slow things down? Keep a close eye on those Q3 earnings and any news about Madero and Larvado. That's where the story unfolds next.